navigating Indian investments as an NRI. Well, understanding capital gains tax is absolutely key, especially with recent changes. This deep dive will simplify it all for you. And look, if you need advice tailored specifically to your situation, reaching out to Tax Acceler is a great option. They also have an AI chatbot on their website, which is pretty useful. And hey, if you find this helpful, please do like and subscribe.
We're focusing today on the capital gains tax NRIs face when they sell certain assets in India or assets deemed to be in India. This doesn't generally cover business assets, though.
Right, so personal investments, property, that sort of thing. What kind of assets are we typically talking about here? Give us some common examples.
Sure, think about immovable property like a flat or land. Then you've got shares in Indian companies, maybe mutual funds focused on India, bonds, debentures, other securities.
Okay.
And also physical things like gold, silver, jewelry, plus units in REITs, real estate investment trusts, and in VITs, which are infrastructure investment trusts, and even some types of unit-linked insurance plans.
So selling that family apartment back home, or maybe some Reliance shares you bought ages ago, those are prime candidates.
Exactly, those kinds of transactions.
Are there things NRIs might sell that don't attract as capital gains tax?
Yes, definitely. Personal effects, clothes, furniture, cars, that kind of stuff are generally excluded. But importantly, jewelry is included. It's not counted as a personal effect for this purpose.
Ah, good distinction.
Also, selling rural agricultural land based on the specific definition in the Indian tax laws is typically exempt.
Okay. Now, a term we hear constantly is the split between short-term and long-term capital gains. Why is that distinction so important for NRIs?
It's absolutely fundamental. The holding period, how long you owned the asset before selling it, determines if the gain is short-term or long-term.
And that changes the tax rate.
Precisely. It directly impacts the tax rate you'll pay. And we need to be specific about the dates here, especially with recent changes. For transfers, so sales, happening on or after July 23, 2024. That's for the current financial year 2024-25 onwards. The rules are quite specific.
So let's start with the common ones, things traded easily, like listed shares, equity mutual funds, listed bonds. For those, if you hold them for more than 12 months, that gain is long-term capital gain, LTCG.
Right. And if it's 12 months or less, it's short-term capital gain, STCG. Pretty straightforward for listed stuff.
But then things shift a bit.
If you're looking at, say, unlisted security shares in a private company or gold, property, even foreign security, the rule changes. You need to hold those for more than 24 months for the gain to be considered long-term.
24 months, that's double the time compared to listed shares. So less than 24 months means it's STCG for these assets. Definitely something to watch.
And then there's this third category, which is quite significant, especially with the recent changes.
Oh, yeah, this is the really interesting part.
We're talking about specified mutual funds bought after April 1st, 2023, also market-linked debentures, and unlisted bonds sold from July 23rd, 2024 onwards.
And for these, get this, it doesn't matter how long you hold them. Any gain is treated as short-term capital gain, always.
Always STCG. That's a massive point. It completely changes the tax treatment for those specific investments, regardless of your holding period.
So, okay, we know the periods. Now, the big question. How much tax you actually pay? Let's go back to listed shares, equity MFs, listed debentures.
All right. For long-term capital gains on these, after July 23rd, 2024, the rate is 12.5%. Plus, the usual surcharge and cess.
But there's a condition, right?
Yes, that 12.5% rate is applicable only if the securities transaction tax, STT, has been paid, which it usually is on exchange transactions. Oh, and also, starting financial year 2024-25, there's that LTCG exemption up to 1.25 lakh rupees.
Good point. And for short-term gains on those same listed assets, if sold on or after July 23rd, 24 with STT paid.
That's taxed at 20% plus surcharge on cess.
Okay, now shifting back to the others, unlisted shares, gold, property, foreign securities. What's the LTCG rate there post-July 23rd?
It's also 12.5%. Plus surcharge and cess. But, and this is really crucial for NRIs.
Let me guess. Indexation.
Exactly. No indexation benefit is available to non-residents from July 23rd, 2024 onwards for these assets.
Wow. That's a big change. Indexation helped account for inflation, reducing the taxable gain. So losing that could mean a higher tax bill for NRIs on these long-term gains.
It definitely could. And for short-term gains on these unlisted assets, gold, property, foreign securities.
That falls under your regular income tax slab rates, right? Plus surcharge and cess.
Correct. taxed at slab rates.
Okay, and let's quickly circle back to those specified mutual funds, MLDs, and the unlisted bonds sold after the cutoff date.
Right, the ones always treated as short-term.
So the gains there are taxed.
As STCG at your normal income tax slab rates plus applicable surcharge and cess. Simple as that, because they're always short-term now.
It's worth maybe just quickly mentioning the older rates for context. Before July 23rd, 2024.
Sure. For listed share Sequity MFs, LTCJ was 10%, STCG was 15%. For the unlisted category, LTCG was generally 20% with indexation or 10% for unlisted Indian company shares specifically. So things have definitely shifted.
Right, and just fundamentally, how do you calculate the gain itself?
The basic formula is pretty simple. Take your sale price, then subtract your purchase costs, and also subtract any transfer expenses like brokerage fees. What's left is your gain.
Okay, one last very important point for NRIs, DTAAs.
Absolutely vital. Double taxation avoidance agreements. India has these treaties with many countries. If there's one between India and where you reside, you might get tax relief in India, potentially reducing your tax burden, but you need to check the specific treaty and meet its conditions.
Definitely worth looking into. So wrapping this up, understanding these nuances and holding periods and the updated tax rates is really essential for you as an NRI investor.
It really impacts your decisions. The rules are specific, depends on the asset, the timing.
Exactly. And remember, this is for general guidance. For advice specific to your investments and residency status, reaching out to a qualified expert like TaxAcceler is the way to go. You can also explore their AI-powered chatbot on the website for initial queries. If you found this deep dive useful, please do give us a like and hit that subscribe button. It really helps others find this information too.
Definitely.